the host of Startup REI Show, the number one real estate investing show for startup angel investors. If you haven't done so already, please check out startupreishow.com. And today we have a guest, and I'll bring him on. His name is Anton Q, and here he is. How are you doing, Anton?
Good morning. Good. Thank you very much.
Awesome. So, um, thank you for very much coming on here, and I really appreciate your time. I would like to ask you questions in regards to hopefully lowering the barrier of entry for startup angel investors looking to diversify into real estate. Does that sound good?
Sounds great.
Awesome. So I have my first question here. I typically ask a personal question.
Sure.
It could be, um, are you happy with what you're doing? But really, its main purpose of why you're living. Why do you do what you do right now?
Yeah, I relatively very happy where I am in terms of both in my life as well as my professional career.
Okay.
I find in the last 6 7 years I find myself to be very balanced in
Yeah.
terms of taking some risks as well as be able to generate stable cash flows, income streams, and as well as taking some chances. So
Right.
that's where I always want to be.
Okay. That sounds great, actually. And deeper than that, on a personal level, aside from like these titles, angel investor, commercial investor, on a deeper level, why do you do what you do? Family, friends.
Well, yeah. I'm a first generation immigrant.
Oh,
Came here with nothing,
okay.
literally $60 in my pocket,
Wow.
and came here. I worked since I was teenager,
Mm-hmm.
and made every dime on my own, and I've worked in every possible jobs that you can think of through college. Dishwashers,
Wow.
driving cabs, and painting houses, anything, flea markets, anything you can think of. I've done it. And so I put myself through college and supported my family and
Mm-hmm.
raised a family. And I studied finance. I become an investment banker. And at the times in the late 80s, I saw a lot of opportunities in commercial real estate. And at the time, being an Asian American,
Mm-hmm.
it was a very mainstream business, and a very few. There were a lot of brokers or real estate advisors in
Yeah.
the residential business, but very few in the mainstream commercial real estate business. I thought that was an opportunity.
Right.
So I went into that business, did extremely well, was able to basically build a very successful career,
Okay.
also become a banker, and then start investing in many different alternative assets, and then was able to build a commercial investment property portfolios and be able to generate some cash flows and income stream that which allowed me to do other things.
Correct. Actually, that's the next question I do have, which is, can you talk a little bit more about your background? I know you just talked about your real estate background. What about how you got into startup angel investing? Um,
Sure.
mhm.
So during late 90s and early 2000s, the fact is I still have had a lot of connections and friends
Mhm.
that were in the investment banking, or later on some of them transitioned to VC and PE areas, and we would go to dinners and meetings and get-togethers, and they would say, "Oh, yeah, well, I'm in this like really hot deal,
Right.
startup in the Web Point 101, right?" And there
Right.
was a lot of opportunities, a lot of pop, a lot of hype, and so I wrote a few checks and put the money in there,
Hmm.
and most of them went busted, as
Oh,
we all know. And
yeah.
I couldn't even get mad at those people because those are my friends, right? I didn't have the ability to do due diligence, didn't have the ability to select the deals,
Hmm.
and I was basically FOMO into a lot of those deals. Let's just
Yeah.
face it. Let's just call it what it is. And so I've always been very interested in any segment that I'm involved in. I spend time, and
Right.
so I spent a lot of time in with my finance background, with my real estate investment background. So I've spent a lot of time analyzing deals, things of that nature. And later on, I just felt I need to be, if I want to do this, I need to be spending significant more amount of time to develop my network, to develop opportunities that were worthy of investing, And
Hmm.
like I don't know if you ever play sports, and
I
you
do.
to be good at anything, it's 10,000 hours, right? My
Oh,
kids, everybody's sports, playing sports. Doesn't matter how talented you are, got to put in 10,000 hours to be good at anything. And so I over the years I've developed a network of these angel investings, and we participate in investing some venture capital firms, being
hmm.
LPs, and developing those up, and go to a lot of seminars, go to a lot of conferences, and start seeing more deal flows, whatever. On average, right now, part of my group that I'm a part of a group that we're seeing 1,000, 1,500 deals a year. So we analyze a lot of deals, and that's that's got kind of repetitiveness and network and the ability to also lean on each other's expertise. I have a lot of colleagues who are way smarter than I am, and they have a lot of experience in a lot of different industries and domain expertise, and then so that's how you build your sort of a second business.
So I'm hearing commitment first, consistency second, and then really analyzing everything as much as you can and being exposed to it. And then on the back end, of course, there's the educational portion and exposure. I think
Yes.
those two are the most important things, not only in real estate but also startup angel investing. So I really want to thank you for sharing that. So why diversify in real estate for the startup angel investors that are listening to this?
Yeah, real estate has been, especially commercial real estate, has been great for me. I mean, I
Okay.
built a career on it. I was very good at it, what I was doing, and I was very high producing. And then later on, I realized in mid part of my career, I
Mhm.
realized, transactional businesses always go up and down. Advisory consulting business go up and down. So you need to build a little bit more cash flow, steady income streams, especially when I, got married, have families, have kids,
Yeah.
and so as I start diving into more on asset management, I developed a property management business, and a lot of those clients. So kind of you asset manage it, and I syndicate deals. I'll be partners with them,
Wow.
and so those networks built a very steady foundation of a cash flow stream for me, and then that kind of allows me sometimes to move a little bit away from the agency consulting or advisory business. In sort of throughout the market ups and downs, I have a foundation of an income stream that I was able to build, and
Right.
that allows me to say, so, you know what, I'm going to start taking some chances and doing some things a little bit different, more higher risk, potentially higher rewards. And that I think angel investing provides that. Number one. Number two, I've got two, grown young children that got just college graduate that they're working now. But throughout their growth stage, their sort of attitude towards technology and everything else, adoption of the usage of gadgets and everything else are very different. So it creates a great conversational piece between me and my kids. And actually, a lot of times, several deals that I invested before I invested, I actually went to them. I said, "What do you think? What do you think?" There's this famous, really well known now called the Overtime Sports app. I actually consulted them before I invested because,
Wow.
you know, and again, you want to connect it with the young people. That's one of the reasons why I'm willing to talk to you,
Yeah.
and for young people who wants to start something new, whatever, and connecting, discussing those topics, I'm always open.
No, that's so important. And investing in the future and understanding what your kids will hopefully experience later on, right?
Yeah.
And so you talked a lot about cash flow and idea of high risk, high reward. And so my question then is like, can you talk much deeper in the importance of choosing cash flow um, versus IPO, hoping for IPO in the future?
Absolutely, because one of the best things, or in my opinion, about uh, commercial real estate or residential real estate in general as an asset class, if you make a commitment to work in that asset class, in the long run, through ups and downs, if you don't over leverage, you'll always to be able to hang on to it in California alone,
Mhm.
we live in Bay Area, California, or you're talking about majority of a major coastal cities or core gateway cities,
Correct.
real estate over a long time has always maintained its value because now we also have environmental concerns, and we have a housing shortage, we have commute issues. So there are a lot of elements that will make real estate a steady, long-term appreciating asset. However, uh, one cannot over leverage, and
Correct.
because market is going to go to cycles. So I've been through 3 or 4 cycles. This is probably the longest the market cycle. We're heading toward 13 years. In the past, it's always between 8 to 10 years. You're going to have a boom, you have a bust, right?
Right.
And so that's steady cash flow. But then in terms of a startup business, that's completely different.
Right.
That is high risk, high reward, but market is changing so much since 2000, late 90s, internet change, and then mobile phone development, now broadband, and now all of a sudden crypto technologies.
Yeah.
Everything's developing so fast, and applications are so easy to be adapted, and so one cannot ignore things like that. And that's
Right.
where I want to be, to creating that kind of a balance.
So then my question to you is, where's the balance in your portfolio? Is there like a certain percentage for how much startup money you put into to those projects, and like real estate is like 80-20 or whatnot? Mhm.
Yeah, by nature of the startup high risk profile, I think in general, in our industry, one should not put more than somewhere between 3 to 5%, or no more than, absolutely no more than 10% of your net worth into these very, very high risk
Correct.
early stage investments. But again, it takes time to work at it, and then that's another way of reducing your risk, right? If you're seeing 1,000 deals and you're investing 10,
Hmm.
you know that's less than 1%. And so if you are being that selective, chances of your going going under is a little bit like, hopefully a little bit less, with the expertise, with the people domain knowledge to help you.
Right.
But in general, startup business, a very high percentage of them don't make it, right? Versus real estate, you have to work at it, but you can see cash flow.
See, that's the important thing, where I'm like, okay, a lot of some of my studies that I've seen on, like, I did a short market study on Twitter with communicating with angel investors. Where do they put their money? And most of them, I'm not seeing that they're aware of these real estate opportunities. So can you talk a little bit more about that?
Sure. Well, this is just many different kind of angel investors.
Correct.
I've seen a lot of angel investors who came from a tech background. They either are very successful in their own startups and they exited, or they worked at some of those really
Big
big
company.
unicorn companies, the Apples and Airbnb, Googles, Facebook, and whatnot, and they've accumulated enough of a wealth where they could allocate and invest. A lot of them, because technically they're very strong, they've got a big network of friends who are starting companies where they know the domain and they know the founders. So those are the type of. There's other type of investors. Some of them like me, maybe not coming from a tech background, but from other industries, were more looking at as approaching as a investment class to
Ah.
diversify portfolio,
Hmm.
right? So the vice versa is, a lot of angel investors, they come from tech background and they are heavy in investing early stages, or in stock markets, or they have a very heavy stock portfolio. For example, if you work for Apple for 20 years, you've accumulated a huge amount of stock options, but that in your wealth distribution, that's probably overweight, significantly overweight. But there's less of that awareness sometimes, that you should diversify some of that and put that into real estate, put it into other alternative assets that will grow the portfolio in a more balanced way.
Correct. 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 Oh, big topic. Can talk about tax in regards to real estate and startup
Yeah,
angel investing, especially with the IPO, because I'm trying to get a better understanding of active versus passive income. So,
right. Well, again, the passive income will be an example of, if you have some cash out, a couple of $1 million, you go buy a Walgreens.
yep.
And Walgreens typically signs a 50-year lease, and there's a guaranteed, hopefully, there's guaranteed income stream, and it's guaranteed by Walgreens. As long as the Walgreens is doing well, and company continues to pay rent, you can basically sleeping while you're collecting income.
Right.
Active investment will be going after to look for real estate that's undervalued, that's undermanaged or mismanaged, that has vacancies, has some issues, or need a renovation, and you acquire it at an attractive price that's significantly discounted to the replacement cost.
Correct.
Then you put in some capital to upgrade it and to hopefully get a higher rental income, and
Mhm.
that will give you a higher value appreciation over time. And real estate has all of these other tax advantages. You buy real estate, you have a depreciation schedule that can offset some part of your income. And real estate, if you buy it as an investment property, that you when the value appreciates, you sell it. You can 1031 use the RIS code 1031 to exchange the property into a larger property where you defer all of your capital gain taxes. So there are many different ways to sort of shelter part of your income and take advantage of a tax code and be able to create an even bigger income stream over time.
This one, REI value proposition. If the value proposition of real estate and its benefits and features are so attractive, why aren't so many startup angel investors getting into this form of domain?
Return. So, because in real estate, in historically, if you can buy a good real estate and manage it, you can get anywhere from 8 to 12%
Yep.
RR. It's considered really good. Now, the last few years, because the interest rate is so low,
Yeah.
people are very happy with 6% or 5%. Whereas in tech business and in especially in startup or you're talking about valuations can change in literally in 6 months, double or tripling. And venture capitalists, a lot of times, 20, 30, 40% is considered pretty normal. If you're in the SaaS software business, their margins usually 70%. And versus, if you in real estate, it's said, 8 to 12% is considered really, really good.
Right, right, right.
So there's a lot of people, thinking real estate maybe if they know what they're doing in the tech business, they always think, if I put money in real estate, it's kind of boring in a way.
I
That's the
got it.
typical.
So it's more about the investment profile, and not only just understanding the domain, right?
Yeah, well, again, everyone is different in their investment goals. I think I'm pretty sure your investment goals with mine is a little bit different
Very much.
because you're young,
Risk
you're
on.
aggressive, risk on. You want to grow your portfolio. You want to make more. Where versus maybe 15 years later, you have kids, you have family, you may think a little differently. I want to have some steady income. I want to be a little less risk, and I want to make more of a steady cash flow. So different stage of life, probably people have different, and then obviously tech has typically have a younger age crowd. People probably start not even start thinking about that much of that kind of building that kind of portfolio. I know quite a few young guys where they live in an apartment, they move from place to places, they go dive into startups 2 or 3 years, they hit, miss, whatever, and they move on.
Yep.
And a lot of people do side hustles, just different kind of lifestyle or a different goal at different stage.
So in this case, how can startup angel investors learn more about these real estate opportunities?
Well, there are a number of real estate startup companies actually. Tech companies started real estate. We've invested in this startup company called Lex Market. So
Okay.
what they've done is they've actually securitized and take the approach to democratize the commercial real estate investment, and they take, for example, they're currently taking a property IPO. So instead of buy
Whoa.
this multi-million-dollar commercial real estate property that's anchored by Wells Fargo Bank and basically some great tenants, has an income stream, you can buy a piece of it as little as maybe, I don't know, a couple $100. And it's going through like just like buying stock. You can trade this, and so now you have all of a sudden you have the opportunity, instead of spending hundreds of thousands of dollars or millions of dollars to buy a property, you can actually start participating in these commercial real estate backed assets, just like trading stocks. And I think that kind of trend, no different. There's a number of startup in the crowdfunding sites where they do a real estate project. They'll just raise capital through crowdfunding,
Right.
where the funders will get the certain amount of returns. So those are different ways of kind of I think the lines get between the traditional assets and tech are really getting more and more blurred,
Yeah.
and so it's not an either or. There's as time goes by, I would assume there's going to be more and more opportunities that you can get into an industry without really devoting a huge amount of resource into it.
No, they're actually solving a problem where in multifamily syndication, for example, you need, or typically you would want as a fund manager,
Yeah,
accredited investors, and
yeah,
there's a minimum of $50,000 just to
yeah,
invest, right?
yes,
And
yes,
so Lex actually democratizes that and says, hey, you can invest $250. I mean, I
yeah,
was just looking at their
yeah,
website.
yeah.
So how different is that, and how better is that for not only the fund manager, but the individual investors?
Well, first of all, there's also in real estate, like any other business, right? You have a good operators, you have a okay operators, and you have not so great operators. The
Correct.
transparency itself, in the past, there's no transparency.
Yeah.
You give money to 50 grand, as I said, somebody doing a multifamily deal, you give them 50 grand. There's very, it may be at best they give you a quarterly report of some sort,
Yeah.
but this kind of approach in the long run, you tie into social media, you tie into online rating, you tie
Wow.
into real-time performance, and information becomes a more and more transparent, where that governance part and the performance part, if somebody does a really poor job, that sponsor or operator won't be able to raise more money or do more projects. But if you are, a really reputable first class operator,
Correct.
and the assets you brought to the market is just like a class A managed, and it provides that the return exceeds expectations, they
Right.
are going to be raised more and more projects. And so that's kind of a differentiation. Like it's always in tech the same way, the product is going to differentiate, not kind of make you stand out from the competition.
Okay. Okay.
But there's got to be a connector somewhere between the average guy who wants to, not just a tech angel investor, but people who want to diversify into commercial real estate or vice versa. Because a lot of other sort of asset class investors want to get into tech now. It's much easier. There's angels list. There's all these
Yeah.
startup funders and all that stuff. You can participate in a smaller amount, because in the past, if you want to participate in the VC, you
50K.
have to write a certain big amount of checks, right? Because now
Right.
you could just same thing. A lot of those startup crowdfundings, whatever, you can just write a check for $1,000 and be able to potentially take some upsides.
Earlier, we've been talking about deal flow. So
Mhm.
with startups, you said five to no more than 5%, for example, as in your portfolio. But you're looking at 1,500 deals, right?
Right.
That's a time commitment in itself. How about
Yes.
real estate deals? Are you also looking at those?
Yeah, real estate deals, I think it's the same way. For example, if you sell a house, you want to become in real estate, you want to buy a house, sell a house, you got to go to a certain neighborhood. You got to go just really look at the houses, right? Because if you don't really get down to the real estate, to put it this way, real estate is a very regional business.
Hmm.
See, you can talk about Google search, and that becomes a worldwide business. Whereas real estate, I think, is still very local, very regional business, because a one block of location difference could mean huge, difference in values. If somebody who have young kids, they want to be closer to school and certain school district, and that has different value. And every house is built differently, right? Whether it's architectural, whether it's material, whether it's just access to certain points and to transportation, they all make different. They have a different features. That's the huge difference in potentially huge difference in value. And
Correct.
so you got to go really canvas the area. You got to really go to compare and understand. Maybe not 1,000 houses. You're not going to look at 1,000 houses, but at least you have to look at 10, 20 houses before you buy. Or if you want to go to a shopping center, you want to spend a fair amount of time go look around at who's coming in, who's coming out, what kind of tenant mix, who's shopping here, who's spending the money. Again, all of those things just on paper don't work.
Correct.
Yeah,
No, that's a great point. So while I have you here, let me pitch.
sure.
Um, this is my investment thesis. I'm looking at markets like Texas, Austin, Texas, just the surrounding areas because it's too expensive in Central Texas.
Yeah.
And if I or some of my partners were to pitch you a deal, would you look at it? Because it is
Uh,
a tech-enabled area.
yes. No. The yes or no. Yes, Texas Austin is a hugely growth area, and
Yeah.
all the tech companies being there, and prices already gone up, and I think it's continued going up and all that stuff. But no, because I don't look at anything far away.
Oh.
We again, I said it goes back to the same thesis. Real estate is very local business,
Mm-hmm.
and we've been operating in San Francisco Bay Area, Northern California, maybe a little bit larger, for a long time. And this
Yeah.
this is where we know we can easily pull resources. If
Correct.
we acquire an asset, we need to architectural design. We need to find a contractor. We need to property manage, asset manage. We need to find all kinds of a resource to support project. We have that. And going into a long distance situation, uh, unless we build a much bigger team,
Yeah.
and I don't think it's a cost effective for us. So we kind of like generally speaking don't look outside of Northern California, or our concentrations is still Bay Area. Bay Area is still what we believe in the long run has its value.
Got it. Got it.
Yeah,
Got it. Well,
yeah,
thank you for that. I
yeah.
was mentioning in regards to
Sure,
like as a passive investor, but I think it is
sure.
important to, as for your investment risk reward profile, it's all about it's mainly about regional and actually understanding to have more control.
Yeah, yeah.
Right.
Understanding what's going on,
Right. Right.
what's
Right.
going on. Yeah, absolutely, absolutely.
So we're coming to a close here. So what are
Sure.
your 2 cents? Any advice for angel investors to either in real estate or angel investing?
Well, vice versa. I think for real estate investors, I always would say to a lot of my actually fellow real estate investors, the world is changing.
Yeah.
Uh, Whether you like it, you understand it, you don't understand it, you got to embrace it, and embrace it in terms of a technology changing, and that comes with everything, not just a simple sort of apps and whatnot. Energy savings, uh, sort of a point of contact, and efficiency in managing properties. Everything is being sort of disrupted with all this new technology, and
Yeah.
it's a good thing. For
Mhm.
example, the 70-80% of our tenants now pay everything online through ACH instead of putting a stamp and putting in the envelope, and then we have to wait for it and check out lost. All
Right.
these efficiencies are being improved. So if you're in the real estate in other non-tech business, you got to start looking into more opportunities in investing in tech business, and vice versa. If you're successful
Right.
in angel investing in tech, in all of these startup environment world, and you made your sort of a wealth through that, and you should really consider diversify a part of that wealth into something like alternative assets or real estate, and that could create a steady long-term income stream and buy in a good growth area where there's also appreciation on the assets itself.
Yeah.
So
Thank you very much. Those are wise words coming from someone that actually came from there, those two industries. So, how can people learn more about you? LinkedIn.
yeah, LinkedIn would be a good place to start. Yeah.
So here's the link that I actually posted here. But you could just search up. His name is Anton Q, and then hopefully just connect with him, right? And I really appreciate you being here, Anton. It's been a blast, and I gained a lot more information that I could ever ask for. Thank you.
I thank you very much. I enjoyed as well, and good luck.
Thank you. I appreciate it.
Okay, great.
Industry